All right, so now today we are going to talk about who's caught in the US tax net and why. What are some strategies that we can use to avoid double taxation? What are the hidden traps around the foreign accounts, businesses, and gifts? What is the ultimate escape hatch, which is expatriation? And then in the end, we'll have a Q&A session. Please keep submitting your questions so that we can address them at the end of or towards the end of the webinar. As time permits, we will try to address all of them. We can go to the next slide. So most of you probably know that US taxes its citizens and green card holders on their worldwide income, regardless of where they live. This is a unique approach developed among developed nations. It's a tax net that follows US persons wherever they go. On the other hand, there are countries that are based on the territorial tax system, which only taxes income earned within the country's borders. And there are then countries that only tax the residents of that country, but stop once they move out. So because US follows the, US follows the citizens wherever they go, it is very important to understand the complex compliance reporting and, all the heavy penalties that come with it. So in order to determine who's caught and why, it is very important to know your US tax status. Now, US tax status is very different from your US immigration status. So immigration status is basically determined by the US immigration policies or the immigration laws. But US tax status is determined by the IRS according to the Internal Revenue Codes. And generally it is for citizens it doesn't even matter if if you are in the US or outside of the US, because you need to file your US tax return wherever you go. But generally it falls into two categories. You are either a resident alien or a non-resident alien. So to determine if you are a resident alien and you need to file your US taxes, you need to pass one of these two tests. So if you're a green card holder at any time during the tax year, you are considered to be a tax resident of the US, and you are a lawful permanent resident, and you need to follow the same requirements as a US citizen. And the other one is the substantial presence test, which is so substantial presence test calculates the number of days that you have been present in the US. And it's generally over the last 3 years. So basically 3 years, the 2 years preceding the tax year that you're considering to file the tax return. And 31 days should be in the tax year. If you fall in one of these two categories, then you need to report your worldwide income and also need to report the foreign bank accounts, because you're just taxed like a citizen of the US. Then the other bucket is the non-resident alien. So a foreign national who has come to the US and who does not fall into either of the two categories, the green card test or the substantial presence test, is considered to be a non-resident alien. And non-resident aliens are they are only taxed on their income that they have earned in the US. So not the worldwide income, and they don't even have the requirement to report their foreign financial bank accounts. Now, if you're a non-resident alien and you need to file a tax return, but you don't have a social security number or an ITIN. An ITIN is an individual taxpayer identification number. You need to file a form called W7 with your 1040 NR that you'll be filing. And there are certain documents that you need to attach with that form. You either need to send the originals with the tax return, or you need to send certified copies. We can help you with that if you are, if you're one of the people needing help with this. But this form generally goes to the ITIN services and not to the IRS. And the 1040 NR needs to be paper filed and cannot be electronically filed because you don't have a social security number or an ITIN. So now, if you are living, so if you're a green card holder or a US citizen who is, who is not living in the US anymore and living in some foreign country, and you have income in that other country, but you still need to report it to the US, then there is a possibility of double taxation. So how can you avoid that double taxation? We have some strategies. The IRS has, has some strategies that people can adopt. But then again, everything needs to be very carefully studied so that, because the rules are a little bit complicated. The first one that I'm going to talk about is the foreign earned income exclusion. This is an exclusion that can be claimed on Form 2555 along with your 1040. It's also called the golden tickets for expats. There is an exclusion limit that gets updated every year for inflation. For 2025, this limit is $130,000. Now, this exclusion only applies to earned income. So it is only applicable to wages and self-employment income. It is not applicable on passive income like, investment income, portfolio income, etc., or retirement income. Generally, there are two tests that you need to meet in order to qualify for this exclusion. One is the bona fide residence test, and the other one is the physical presence test. So bona fide residence test, as the name suggests, this basically tests the quality of your residence in another country. So if you've moved out from the US, they will see your intent and your financial and social ties with another country. They basically see if your tax home is in the other country and if you intend to stay there for an indefinite period of time. Now, there are some examples that I can tell you. So if you are in a long-term employment in a foreign country without a fixed end date or fixed or definite end date, if you're setting up a permanent home for yourself and your family, so you basically are showing an evidence of your intent, such as, if you have voter registration or your address on your driver's license or your income tax returns, then you fall in this bona fide residence test category. And you can use this for an earned income exclusion. You have to prove that you were out of the country for the entire period of 12 months that you're considering this exclusion for. The second one is the physical presence test. It basically tests or calculates the number of days that you have spent outside of the US. It is a minimum of 330 days in a 12-month consecutive period. And then based on the number of days that fall in the tax year, like suppose, for example, we are talking about 2025. So if you take a 12-month period from, say, April 1st of 2024 to March 31st of 2025, then your proration, so your exclusion is prorated only for the part that we are, that the tax return is for. So for 2025, it will be the 3 months out of the 12-month period. So your $130,000 exemption or exclusion is going to get prorated. So if you meet one of these two qualifications, you are able to take this exclusion. There is another strategy that you can use to avoid double taxation, which is the foreign tax credit. Now, foreign tax credit is generally more beneficial for high-income earners or those who pay a higher tax rate abroad than in the US. This is a dollar-for-dollar credit for income taxes paid to a foreign country. And generally, it is, you can take it along with the foreign earned income exclusion, so you can take it with the foreign earned income exclusion, but you cannot use the same income that you have used for the for Form 2555 for the foreign tax credit. So say you had foreign income of 250,000 US dollars, and you have already used 130,000 for that foreign earned income exclusion. You can only use foreign tax credit for the remaining part of your income. So there is no double dipping allowed. And the foreign tax also gets prorated for that amount. Now let's talk about some of the hidden traps. Um, in my experience in the last 10 years, I have seen a lot of people come to me for FBARs. FBARs are foreign. So this is a reporting requirement for, again, individuals who are US tax residents, citizens, or green card holders. It's called the foreign bank account reporting, and this is a reporting that is separate from your 1040. This goes to the FinCEN, which is a Financial Crimes Enforcement Network, and it goes on Form 114. Now, FinCEN is also called the watchdog for foreign accounts. The key trigger is having an aggregate balance of over 10,000 US dollars in any foreign financial account at any point during the calendar year. So, at any point during the calendar year means even if you have more than $10,000 for a minute, for an hour, or a day of the calendar year, you need to report this on your FBAR. There is no exemption from this, and the penalties are up north of $10,000. You do get an automatic extension from FinCEN for all FBAR filings. It extends your due date from April 15th to October 15th. It does not depend on your 1040 filing date. So even if you are filing your 1040 on April 15th, and you're not able to collect all your FBAR data by that date, you will get an automatic extension, and you will need to file it by the October 15th deadline. One thing to note for this is even the nominee accounts that you have just signature authorities in, they will also count toward this filing. So, say your parents have an account in Ireland, and you are a nominee in that account, you need to report that on the FBAR. How we generally do it is we use the year-end exchange rates that are published by the Treasury to convert the foreign currency into US dollars for this reporting. The second kind of reporting for foreign financial accounts is the 8938 form, and it's also called the FATCA, which is Foreign Account Tax Compliance Act form. This is an additional layer of transparency along with the FBAR. So FBAR goes to the FinCEN, but FATCA goes to the IRS. So this is filed along with your 1040. There are different reporting thresholds for the 8938, and it also reports specific foreign financial assets that may or may not be covered by the FBAR. This form is filed with your tax return, as I already mentioned, and the filing deadlines are the same as your 1040. So if your 1040 is due on April 15th, this form needs to be submitted along with your 1040 on April 15th. If your 1040 is extended, as in you file for an extension of your 1040 and it is due on October 15th, then this form is also due on October 15th. So there is no automatic extension for this form. Now let's talk about the thresholds. There are different thresholds for somebody living in the US versus somebody living outside of the US for green card holders and US citizens. So if you're a single person or married filing separately, then the threshold is $50,000 on the last day of the tax year, or $75,000 at any time during the year if you're living in the US. But if you're living outside of the US and you're a green card holder or a US citizen, then your thresholds are $200,000 on the last day of the tax year, or $300,000 at any time during the tax year. For people who are married filing jointly, these thresholds are doubled up. So, for somebody who is married filing jointly living in the US, the threshold would be $100,000 on the last day, or $150,000 at any point during the year. And if you live outside of the US, then it's going to be $400,000 on the last day of the tax year, or $600,000 at any time during the year. So then in those cases, you need to file Form 8938. There are certain situations where you are accepted from filing 8938, which we can talk about later, or, we can talk about people's specific situations. But these are the thresholds. Then the third one that I want to talk about is the Social Security and Medicare taxes trap. So, say you are somebody who, you are a U.S. citizen or a green card holder who has moved outside of the U.S., working in a different country, or you are a foreign national who is working in the U.S. Um, you need to pay the self-employment taxes either to that country or the US. FEIE, which is the foreign earned income exclusion, it does not exempt you from US self-employment tax. So it does exempt or exclude that $130,000 from your income, but you still need to pay the Social Security and Medicare taxes. This is more important for people who split their careers between two or more countries. What is the solution for this double taxation of Social Security and Medicare taxes? There is a concept called totalization agreement. This is a tax truce. These are bilateral agreements between the US and other countries that prevent double taxation of Social Security and Medicare taxes. So say you are a foreign national, suppose a citizen of Finland, and you have come to the US to work, and you already pay Social Security in Finland, then with this totalization or bilateral agreement, you will be exempt from paying Social Security and Medicare taxes again in the US, because of this bilateral agreement. So, but to claim this exemption, you must obtain a certificate of coverage from the Social Security agency of that foreign country and attach a copy to your annual tax return, the 1040 and the Schedule SE that you are filing. So, just please check if the country you're working in has a totalization agreement with the US. This can be a savior for everyone who is in this situation. With this, I will transfer it over to Heidi.
Thanks, Swati. We're actually going to move a little bit into the business world and investments. So I'm going to talk first about if you're a US person that happens to have an investment in a foreign company, what does that mean? So a foreign entity, just like the US, can be taxed differently for US tax purposes. So in the US, we can have partnerships, S corps, disregarded entities, and guess what? For foreign purposes, we can have the same thing. We can have a corporation, we can have a partnership, a foreign branch, or a disregarded entity. The key of figuring out what type of entity you actually have for US purposes is looking at the legal liability of the owners in that foreign country. So, for example, if I have a United Kingdom Limited, you hear the word limited, the owners themselves have limited liability for this company. The default classification, you would think it's partnership, but it's not. It's actually the corporation. Doesn't make any sense, I know. But there is a way that you can actually change how it's treated in the United States for most companies. We would do this by filing a Form 8832. You have some certain timing requirements on this filing, but then you'd be able to change it and treat it how you actually want to treat this particular entity. If you have the ones that don't count, for example, are a Switzerland AG or a Japanese KK. If you really want to nerd out, if you have a WICPA magazine, look in your November one. I will have an article in there specifically going through more of the details on this. So now what happens if you have a foreign entity that's actually conducting business in the United States? They would end up filing a Form 1120F. It looks similar to 1120, so normal domestic corp, but there's a lot more schedules that go into it. Basically, what it does is it only taxes the income that's effectively connected to a US trade or business. We can actually file this form and claim a treaty benefit. I will see this typically with sales of services or SaaS type entities where the return itself has a bunch of zeros on it. But then we file a treaty position on Form 8833, And then that allows us to say, yes, we had this activity, but based on this current guidance, we believe we are not taxable in the United States. This is an area that's always evolving a little bit, so it's always something good. If you know, if you're working for a foreign entity and they're happy to doing activities in the United States, double checking almost every year as to what really should be taxed in the United States. So, what kind of forms are we looking at for foreign business interests? So, the first step really is to figure out if you have a controlled foreign corporation. So, we already went through our legal, figured out, okay, yes, we have a corporation. So, the next step is, do we have a controlled foreign corporation or a CFC? A CFC is entity is considered to be a CFC if the U.S. shareholders own 50% or more of the voting power or value. This is a recent change. It used to just be voting power, but they recently changed it with TCJA to power or value. And then when we have a CFC, part of the income might end up being reported on the U.S. income tax return. The one thing to keep in mind with determining the 50% is sometimes family matters. So if a dad owns, a son owns, and a grandson owns, those would count. Brother, sister don't necessarily count. So again, it can get very complicated very quickly, determining if you really do have a CFC or not, if your family is involved. If you do have a CFC, you would file a Form 5471. This form reports the income, the expenses, and then various other pieces of information that we might need to actually carry to your normal U.S. tax return. There are a couple other reasons why you would file this form. The first would be that you went from a 0% to a 10% ownership in a foreign corporation. Or the second one is if you disposed of an interest in a foreign corporation that reduced it underneath 10%. The third one, some people don't normally think of this, is that if you are a officer or director of a foreign corporation, I see this a lot on captive insurance companies where a company will say, okay, Fred, you are going to be our representative for this captive insurance company. Fred has no clue that he was nominated for this. And he files his tax return and then later on finds out, oh, I should have filed a 5471. Don't worry, we can fix that. The next type of form is Form 8865. This is if you determine that the foreign company that you're working on is a foreign partnership. This form looks very similar to the Form 1065 for a U.S. partnership. Again, there's some additional information that's included. It really does a deep dive into the ownership structure and who really is the ultimate tax owner. The next form is a Form 8858. This is going to be for your disregarded entities or your foreign branches. So what is a foreign branch? Foreign branch is a newer concept. If you say you're a US company, you decided that you wanted to set up shop in Germany, but you didn't actually want to start a new entity. You just wanted to have some people over there putting together widgets. So you would then have a foreign branch, especially if you have an income tax return that you're filing in Germany for that activity, or you have financial statements. This would trigger the foreign branch requirement. Then you decide that, hey, I actually do want an entity. It's going to make doing business a little bit easier. Then most likely you would have a disregarded entity. This next one, the Form 8621, so Passive Foreign Investment Company, we call it PFIC. This is one of the most complicated areas of international tax, in my opinion. Certain investments in foreign companies can trigger this unique treatment. We actually look at two different tests to determine if your entity is a PFIC. There's the income test, which says that if 75% or more of your income is coming from passive income, it's going to be a PFIC. There's also an asset test where if 50% or more of your assets are related to passive activities, it's going to be considered a PFIC. The one thing to remember about PFICs, once a PFIC, always a PFIC. There is ways to get out of it, but it's typically pretty tax costly. So again, this is a very unique and complicated area. The IRS loves to change how we treat these and who elects when. So it's just something, another form to keep in mind. All of these, the penalties for missing a filing is $10,000 per year per filing. The one thing to keep in mind, say that you, oh no, I needed to file a 5471 for the last 5 years. The statute of limitations never started because you never filed. So the IRS could go back 5 years, 7 years, 10 years, and charge you penalties all the way through. So that'd be $100,000 just for missing one. Again, if you ever run into something like this, we can help you figure out, what's the best way forward for that. Now we're gonna, this is kind of a combination of business and individual. Gifts and bequests and transferring to foreign individuals and entities, what happens? So in general, if you're transferring money of over $100,000 or you're receiving money of $100,000 or more, there's some sort of reporting requirement. For individuals, there's a Form 3520 that you actually report the amount of cash that you've received in a 12-month period once it goes over $100,000. Now, this doesn't necessarily have to be cash. It could be real estate. It could be jewelry. Anything that you're receiving that, if you turn around and sell it, the IRS is going to be like, where did you get this from? Again, it's kind of to hopefully avoid laundering of money. The other time that you would file a 3520 is say you're a beneficiary of a foreign trust, and that trust is distributing money to you or income to you. You would report that particular items. The foreign trust itself should also be filing a 3520-A. It is very normal that the foreign trust doesn't do this. So we actually file a substitute form with the 3520 for the individual. On the 3520, the penalties are 10,000 plus. If it's related to a foreign trust, those penalties can get really, really high, really, really quick. And I still sometimes argue to myself as to which one's worse, the foreign trust penalties or this other transferring of cash to a foreign corporation. They're both pretty harsh. So if you're transferring property to a foreign corporation, as a U.S. person, you have to report that on Form 926. In general, if the value exceeds $100,000 or if your ownership changes to be that you went from 0% to 10%, you have to report that. The one thing with partnerships, the K3 has gone a long way to report a lot of what we need for international reporting. It does not address transfers of property. So when you get a K1 from a partnership and you're looking at the K3 doesn't have anything like this on there. You need to look at the footnotes and pay special attention to if there was transfer. Specifically, typically most practitioners, we will say, this relates to Form 926, and just make sure that you're catching that as you're working on 1040s. Like I said, this one also has a pretty harsh penalty. It can be up to $100,000 and or 5 years in prison. I have actually known of a case where this has happened locally. The people just didn't have the cash to pay the penalty, and so they went to prison. Not ideal, obviously. So something that, we want to make sure that we're keeping track of and looking for as we're working on tax returns. Another way, besides what Swati said, the foreign earned income exclusion or the foreign tax credit, another way that you can potentially escape double tax is looking at the tax treaties. There are agreements between the US and various countries. We don't have them with all of them, but we do have them with quite a few. We can actually reduce or eliminate the tax that's being charged. And this can go back and forth. It can be the US getting a reduction, or it could be the foreign country getting a reduction in how much is withheld. For example, if I was in the United States and I received a Canadian retirement plan payout, the default is that the withholding rate in Canada would be 25%. By applying the treaty, I can actually reduce that to 15%, maybe even less than that, depending on the type of retirement plan. And then any tax that I do actually have withheld on that Canadian retirement plan would then be able to get a credit on your individual tax return. The same thing works with if I'm a US company and I happen to pay royalties to a Canadian person. In the United States, typically that's a 30% withholding rate. However, we look at the tax treaty, the royalties actually get a zero tax rate. So it's something to keep in mind if you're making payments in between, yourself and a foreign country. Remittance tax. This is new. Under the OBA or HR1, however you want to refer to the new legislation, there is a 1% remittance tax for anyone that remits money from the US to a foreign country. There are some carve-outs. So if you are doing the transfer via a bank, electronic bank transfer, credit card, those are not going to count. However, if you write a check, a money order, hard cash, those are going to count. We're not entirely sure exactly how this is going to be implemented yet. Some of this is going to be reliant on the banking industry to report these things. If I send a check of $100, I technically should be paying 1% of that to the government. We're not sure. We're waiting on guidance for this particular piece. This goes into effect January 1st, 2026. So hopefully in the next month or so, we'll get some sort of guidance, although I'm not going to hold my breath based on the government shutdown. So it's also possible this might get pushed back. I don't know for sure. So stay tuned if this is something that you do frequently, if you're sending money back to family. It's just another thing to be aware of that is going to be out there. So how can we avoid all of this? So for businesses, there really isn't anything you can do once you start doing business in the United States and you've got a permanent establishment, you're kind of stuck. But individuals, we can actually figure out how to expatriate. So if you're a non-resident alien or a US citizen, you can actually certify that you are complied with all US income tax laws. And here's my form. I don't want to be a US citizen anymore. If you're a green card holder, you literally hand over your green card. Um, it is a little weird because a lot of times the people I've talked to, when they've done this, they've handed it to someone and that person has no clue what to do with it. This is very common, unfortunately. So they will file these particular forms along with, their very last tax return. They'll include that. The one caveat with that is if you're a high net worth person. If you're a high net worth person, so this is someone that has net worth of $2 million or more, you will owe exit tax, most likely. What's exit tax? Basically, what it looks at your worldwide assets and they treat them as if they were sold at the fair market value on the day that you left the country. So it's almost like you died and we're doing an estate return. And it is the exact same rates. It is at the estate tax rate. So it's very expensive to actually expatriate. This particular item works really well for kids that got stuck. I say kids. Um, so, mom and dad happen to have you in the United States, but then you've always been in England. This is a great way to get rid of that US citizenship. The one thing to keep in mind with this is if you do go down this process, you might not be able to come back to the United States. And there's a lot of legal ramifications with this. So it's not just a tax thing, it is also a legal thing. So I would highly recommend that you have a lawyer assist you with getting this all covered to make sure that, what you're doing is going to be what you want for the long term, not just a short term. I'm mad at the government and want to leave the country. This has got a lot of layers to it. So just something to keep in mind though. If you are again, one of those kids that got trapped in the United States, now is the time to do the exit tax if you're planning on not keeping your US citizenship, because your net worth isn't going to be that high. So again, just something to kind of keep in mind. So overall, each person, each business, we're going to have unique facts and circumstances and how their US tax returns are going to work. Um, that typically is, the first thing I try and do is get a legal structure, understand the person's specific facts as to where they literally a resident, looking at what do they own worldwide, just trying to get a good idea as to what's going on. The FBAR and 8938 are those key filings that we have for investment overseas. And someone had asked about what are the specified assets. So specified assets for an FBAR are your bank accounts, investment accounts, retirement accounts. They can be life insurance accounts. Certain life insurance accounts count. They do not include real estate, thankfully. Um, Real estate's got its own little special thing that we may have to worry about, but we don't have to worry about it for an FBAR or an 8938. Receiving gifts or transferring money outside the United States, it's going to potentially have some filing requirements, and the penalties for noncompliance can be super severe. I've always said, and I think I will say this until I retire, I would rather spend 5 minutes looking at your tax return and looking at the documents that you received than spend hours later trying to fix what we could have done right away. So it's just penalties themselves can be super harsh. There are certain ways to get out of some of the penalties. Can't always guarantee that though. Um, Especially if you forgot to file, there are some procedures that we can go through to help you file those late filings. Um, and hopefully we can do a reasonable cost statement to hopefully get you out of any potential penalties. Again, I can't guarantee it, but in most cases, whenever, in my personal situations, I've put a reasonable cost statement in and we've been good. I haven't heard back from the IRS, so that's always a good thing when that happens. So any other questions that you happen to have? And again, feel free to email myself or Swati with any questions that you happen to have. Um, International tax can be super complicated. And I try, Swati tries as well to break it down and make it as simple as we possibly can. Um, it it doesn't take long, and treaties get complicated and you start getting turned all the way around, and that's okay. It happens to a lot of people. Let's see here.
We had a few questions which I think, answered all of them.
Yes, we did. We did.
Yeah. Regarding the tax treaty question, I would also like to tell everyone that although the treaties are all mentioned, all of the treaties are on the IRS website, there is another way to read the treaties, which is also there on the IRS website. So there is a technical explanation to all of the treaties. If you go to the link that I provided, you can find all of those.
Yeah, and then the technical explanations and protocols and mutual agreed upon procedures those are all things that we look at to figure out, what exactly should be taxed, where it should be taxed, how much should it be taxed. It can get very complicated pretty quick. I actually had spent 150-ish hours learning how to read tax treaties. So they can get complicated pretty quick. So if you ever do run into an issue with a treaty, trying to understand what in the world's going on, feel free to reach out. Do have another question that popped in. Current Indian citizen has an Amex bank interest since he was here. Will it be taxed at 30 or 0%? So I'm going to assume you're talking about American interest. So you picked on something that's a little unique. If you have interest income coming from a US bank account, technically it's not taxable. I don't remember the code section off the top of my head, but there is a way to actually get that reduced or removed. Um, so if you would like to just email me your question again, and then I can actually tell you what code section that's under. It's something that it's very common, unfortunately, in the last, I'd say about 5 years, that US banks are starting to withhold or not even allow individuals to actually have US bank accounts. I know uh, literally US Bank and I want to say Bank of America were doing this where they said, no, you can't be an account holder anymore because you're an international person. So something that it's frustrating when you do have that withholding. Hopefully your country allows foreign tax credit withholding. So that's something that you can look into. See the next question here. As a US citizen, if you sell your properties that you own in a foreign country, do you pay taxes on that? Yes, you do. You do pay US taxes on your property. So I treat it just like a vacation house. That's basically what it ends up being is. So it ends up showing most likely, unless you've been renting it out, will show up on Schedule D. You might have taxes that you have to pay in that local country, and those taxes we'd be able to credit on the individual return. So that is kind of it's unfortunate that we have to pick it up, but that's the whole thing with United States taxation, that it's worldwide. Oh boy, this one's nice and long. If I have a sole proprietorship LLC registered in Wisconsin, okay, and transfers money out of the United States account to other US accounts, but the business is performed in Venezuela. When is when income comes, it also comes from US accounts. Is this treated as foreign income? Depends. So depending upon what the work is that's being performed in Venezuela, if it's physical services being performed in Venezuela, or if you've got somebody going down there and performing services, As it's earned, it's considered foreign income. Um, Having the money come into a US account doesn't necessarily change anything. You could literally just swap that out and say Venezuelan account. Um, so it's really when that money is earned in Venezuela, that's when it would be taxed in the United States and potentially in Venezuela as well. All right, I think the questions may have stopped.
Thank you so much, Heidi and Swati. If anybody's got a last minute question, feel free to throw it in the Q&A. Otherwise, you have both Heidi and Swati's email address in the slide deck. Again, I'll be emailing that to you along with the recording of today's session, so you have that reference. Always keep an eye on our website at wegnercpas.com. We're constantly putting out new resources. Swati and Heidi are always contributing to our blog and sharing their expertise in that way as well. So please keep an eye on that. And if you're not signed up for our email list, be sure to do that also on our website so that you receive invitations to any future sessions and our latest blog articles that are published. So with that, I didn't see any new questions come in. Swati and Heidi, thank you so much for sharing your time and expertise today. We really appreciate it. And thank you all for joining us. We'll see you again soon.
Thank you, everyone.
Thank you, everybody.